Since the beginning of this calendar till November 11th, the rupee lost 4.4% in value against the US dollar. It was the second worst performing currency after the Japanese yen. In this episode, we will look at the decline of the rupee, the health status of India's exports and imports, and inflation in the country, because all of these are interconnected, impacting each other either directly or indirectly. Stay with us. Hello and welcome back to Business Matters with the Hindu with me, K. Bharat Kumar. On Tuesday this week, we learned that the International Monetary Fund is likely to consider reclassifying India's foreign exchange regime because of the high volatility seen in the rupee. A Bloomberg article on the topic tells us that the rupee has seen far greater volatility under the current RBI Governor Sanjay Malhotra than it did during the time of his predecessor, Shaktikanta Das. Now, what happens when a currency declines in value? Typically, exports from that country become more competitive versus peers. At a time when India is facing such high tariffs from its largest trading partner, the US, and it's not yet clear whether those tariffs would come down, there's a lot of uncertainty around these tariffs. At such a time, a weaker rupee could help our exporters somewhat. But India imports far more than it exports. And the latest trade data shows record trade deficit. This was for October. This means the gap between imports and exports has never been this high. With more imports, the demand for a global currency such as the US dollar goes up in India, and with faltering exports, the demand for the rupee would decline, thus pushing the currency value down even further. In a note it had put out in September this year, ratings and analytics agency CareEdge said that the rupee had been under stress due to US policies. Because of the US's secondary tariffs that took effect on imports from India into the US to take an effect in August, the total tariff burden for India had touched 50%, making it among the most heavily tariffed countries in the world in the current scenario. India's direct goods export exposure to the US is only about 2% of GDP, but higher tariffs could hit competitiveness and impact growth. Sectors such as India's gem and jewelry become vulnerable. Footwear, textiles, and leather may actually lose market share to Vietnam and Indonesia that face lower tariffs. If the 50% US tariffs continue, that could pull India's GDP growth for the current year to 6%. But if the tariffs settle at 15 to 20% after negotiations, then growth could well be touching 6.5%. These concerns are also weighing on funds flows from foreign investors. Till September year to date, the net FPI equity outflows came to $15.9 billion. Such trends tend to put downward pressure on the rupee, because when investors want to pull out their funds from a country like India, they obviously prefer a global currency like the US dollar. So there is a demand for the US dollar, the demand for the rupee goes down, and hence there's a downward pressure. Hearteningly, the rupee could still gain support from other quarters. The dollar is actually weakening against many other currencies, with the US having its own share of economic headaches. On the domestic front for India, low inflation, RBI rate cuts, and a lower tax burden support India's growth story, says CareEdge. Aditi Nair, chief economist at ICRA, told The Hindu that because of the relative softness in the prices of oil and other such commodities, the recent decline in the value of the rupee will not have a substantial impact on wholesale or consumer inflation in the near term. Ironically, consumer inflation is at such a low that the average observer could be forgiven for desiring to see an upward or a positive impact on inflation to slightly healthier levels. In a note earlier this month, SBI research said that if you took gold out of the equation, October inflation had actually slipped into negative territory at minus 0.57%, which means it's actually deflation. And for a growing economy like India, that's not very healthy. SBI research estimates that FY26 average inflation is expected at around 1.7 to 1.8%. The RBI's estimate for the same period stands at 2.6%. Either way, this is far lower than the midpoint of 4%, that is midpoint between a range of 2 and 6% that the RBI wants to target. Now, let's take a look at India's exports, specifically for October. Remember that when our imports grow faster than exports, or we import far more than we imported earlier, the demand for foreign currency goes up and that for the local currency goes down, because of which the value of the local currency will slide. Total goods exports fell 11.8%, about 34 billion in October 2025, while total goods imports, driven by gold purchases, grew almost 17% to about $76 billion. Imports of the yellow metal drove the October trade gap to a record high. Now, the share of countries other than the US among India's exports actually increased while that of the US, for obvious reasons, had declined because of its punitive tariffs, which means that Indian companies were trying to move away, diversify away from the US to other nations. The share of the UAE, China, and Hong Kong among the top 5 export destinations rose. For marine exports, share of China, Thailand, Vietnam, Japan all increased compared with the year earlier. In ready-made garments, share of the UAE has increased. Bangladesh, Sri Lanka, Nigeria now have higher share in exports of cotton fabrics and made-ups. Again, the UAE and Hong Kong shares have risen in India's exports of precious and semi-precious stones. In a note, SBI Research asks, is it true that these countries are procuring more from India and also exporting more to the US because the tariffs applicable to those countries are much lesser than that for India? It cites the example of Australia. Australia's share of imports by the US in precious stones, semi-precious stones, pearls, has increased to 9% in the January-August 2025 period versus 2% a year earlier. Likewise, Hong Kong registered an increase to 2% from 1% in that period. In its most recent monthly bulletin on the economy, SBI Research noted that the fears around the balance of payments for India potentially turning negative seem overblown at this point. It reasons that on an aggregate basis, India's merchandise trade balance of goods and services has increased very modestly in the period from April to October, even after the tariff meltdown. In a report earlier this month, Yes Securities said that without a trade deal between the US and India, which will help bring down the tariffs, punitive tariffs on India, it expects the rupee to breach or at least touch the 90 mark against the US dollar by March of next year. That brings us to the nugget of information that we have for you in each episode. Did you know that the rupee, or a related word derived from it, is the name given to the official currency for several countries including Pakistan, Sri Lanka, Nepal, Mauritius, Maldives, and Indonesia? The Bhutanese Ngultrum is equal to 1 Indian rupee, which too is legal tender there. And here's the quiz question for this week. In how many languages is the denomination of the Indian currency note displayed on the language panel on banknotes? And here's the answer to last week's question. The question was, who, considered to be the father of Indian mathematics, is speculated to have headed the Nalanda University in 6th century CE. His work helped simplify mathematical computations and helped derive or evolve more complex avenues such as algebra and calculus. The answer, and a few of you got this right as is evident in the comment section on our YouTube channel, the answer is Aryabhatta. That brings us to the end of this episode. If you enjoyed what you saw, do not forget to like, share and subscribe. Until we meet again next week, have a wonderful time ahead.